First and foremost, thank everybody that's joining us on this webinar today. Really appreciate you guys coming out and seeing what we have to do here with the AREAA Default Task Force. My name is Miguel Benavides, and I'm the Vice Chair for AREAA Default Task Force. Really super excited to be on this webinar. I am the past president of AREAA Austin, and I'm the current Vice President and Director of Sales at Chicago Title in Austin, Texas. If you guys don't know, this is the second in a series of webinars brought to you by our task force. And if you missed the first one that Rick Sharga did, he did the whole kind of outlook on the foreclosure market. That was webinar 1. We do have the link. I think I'm going to put the link in chat for you guys because we record this. We share it on YouTube so you guys can access it later. But we've got a number of webinars throughout the rest of the year. As you know, this one is Foreclosure 101, but we've got one coming up on the 19th, April 19th. That's going to be pre-foreclosures. And we're going to try to go through each individual process and highlight them specifically on these webinars so you guys can get kind of like a holistic view of where foreclosure is, where default is. And I am actually joined today by a couple of friends, Sharon Bartlett and Justin Potier. They have a lot of experience and information to share with you guys. And so without further ado, let me introduce them. Now, Sharon is the Executive Director of Operations at US REO Partners. She's responsible for the continued development of relationships between clients and the members of US REO Partners. Her knowledge and experience brings a unique link between all industry professionals. Now, she began her career in financial services and the real estate industry back in 1982 when she joined Freddie Mac. Now, during her 34-year career with Freddie Mac, she gained extensive experience in vendor management, contract negotiation, risk management, compliance, operational law, servicing, default management, REO, quality control, call center, and all other aspects of customer relationships. She has previously worked with other real estate networks, obviously member of AREAA, and she's also a licensed realtor in Texas with Cito Realty. The gentleman, the handsome gentleman you see here, Justin, with the nice suit on, making me look bad because I'm super cash. He currently serves on the board of directors for the National Association of Default Professionals, AKA the NADP. He has served as a board member for a decade and held roles such as treasurer and committee chair. He previously served as a board of director and VP of AREAA's Orange County chapter and served on the default committee. He also has 3 decades of experience in real estate and is currently the area vice president at Villa Home, the real estate arm for the Carrington family of companies. This company is a concierge home ownership company combining industry expertise, innovative technology to provide nearly every aspect of buying, selling, or owning a home under one roof. Now, in this role, he is responsible for growth and delivery of the mission of Villa and empowering agents and brokers to transform the home buying experience as well as the selling process, and provide the easiest way to find, refinance, and own a home through California and Nevada. And he currently works with 27 lenders, servicers, and asset management companies, which you'll learn more about in this webinar, in the disposition of assets throughout the country. Please join me in welcoming our speakers today. So let's kick it off like the gentlemen do, and we're going to go ladies first. Sharon, I believe you do have a slide presentation that you'd like to share with us. And for all of you viewers, if you have questions, if you have comments, please feel free to visit the chat. I will be monitoring the chat and I will be dropping those questions in throughout the presentation. So feel free to ask any questions that come up.
All right. Well, thank you, Miguel. I'm super excited to be here with everyone today, and I'm glad to have Justin as my sidekick. Justin and I go way back. So it's good to see all of you today.
Excited to be here with you, Sharon, and excited about the information we're going to share with everyone on the webinar today.
I know. So I think we probably should preface this to kind of let everyone know. So Miguel mentioned this is a part of a series. And so today we're going to focus on the pieces that occur before a property gets to foreclosure. So we won't actually talk about the real estate owned aspect other than just to maybe introduce that piece to you. So today we're going to talk about the delinquency process. So a delinquency occurs when the borrower first stops making their payments. Then we're going to talk about the loss mitigation process. So that's the process where a bank, or I'll refer to them usually as a servicer. So a servicer could be a bank or a mortgage company, but they're the folks that actually take the payments from the borrower and process them each month. So you'll hear us, probably Justin and I both will interchangeably use those names. And then we'll move into the foreclosure aspect. And that's where we'll probably spend the majority of our time today, talking through the different aspects of foreclosure and how that process works. It's different in every state. So we'll share some high level information about that with you. And then we'll finish up with just kind of a defining what AREAA is and kind of what it isn't. So let's start with the delinquency process. So, and a lot of this may seem elementary to you, but I know we have some folks on the call that are not as familiar with the default and foreclosure process. So I think this is a good kind of high level overview for you. And as Miguel mentioned, Justin and I will be able to answer questions at the end. So be sure to put those in the chat and we'll keep track of those throughout. So a default occurs when a borrower stops making their monthly payments. So that could occur from many different things. Could be loss of income, could be an illness in the family. It could even be instances where the property suffered damage that maybe wasn't insurable. They needed to get items fixed. So for instance, your HVAC system goes out. So unfortunately, there are some people that have to make a decision about whether to make their monthly payment or have heat and air. And so that can lead to a situation where the borrower can't make their payment. So when a payment is not made, a borrower is assessed a late penalty. And on conventional loans, those are typically 5%, 4% for VA loans. But the lender's goal during this delinquency is to work with the borrower to bring their loan current so that it's no longer delinquent. They get back on track making regular monthly payments. Justin, you got anything to add to the delinquency piece?
I do. I mean, I think it's very relevant today, right? When we look at what's going on in the economy, the increase of household debt, there are people across the country that are experiencing that choice that you brought up, Sharon. You know, do I keep the electricity on, or do I make my mortgage payment, or do I keep the kids in daycare, or do I make the mortgage payment? So it's definitely relevant today. And I would expect that going forward in the next 12, 24 months, that's going to continue to be the case throughout the country.
Yeah, I would definitely agree. Typically, as things become more expensive, it becomes harder to make your mortgage payment. Just a couple of things I'd want to point out in this space before we move on to loss mitigation is that during the lockdown, when things, you know, when we were all working from home or some not working, both of the GSEs. So when I say GSEs, I'm talking about Freddie Mac and Fannie Mae. So they own the majority of the loans that are out there. So these are loans that are not portfolio loans, and a portfolio loan is where a lender or mortgage company, they hold it themselves. So they hold it, they service it for the most part. But GSEs are, they serve a huge role in the housing industry, and they have their own set of requirements that they follow. And so I did want to just share a few things that changed recently due to the post-crisis environment. One of those things was the frequency of contact. So both of them have a requirement that their servicer or the bank or mortgage company reach out to a defaulted borrower. And so it was a contact every 5 days. Now they've upped that to 7 days. So they've reduced the span between those two time frames. Also, and we'll get into this more in the foreclosure piece, but when the loan is far enough into default and it looks like workout's not going to help the borrower, the servicer is required to send a breach or an acceleration letter letting the borrower know, hey, your loan's getting ready to go to foreclosure. Well, as far back as I can remember, that's always been 60 days. Well, that's now been up to 75 days. So they are allowing people a little bit longer to try to get things worked out before they start moving down the path. And then inspections. When a property became 45 days delinquent, a servicer was required to inspect the property at that time. So the intent there was, to determine, is the property occupied, who occupies it, and what kind of condition it's in. So that was expanded out from 45 days to 60 days. So I'm just sharing those with you in particular because they're recent changes. They're things that took place as a result of our lockdown recently. So I'll move us on into loss mitigation. Now, once a borrower misses 2 or more payments, the servicer's goal obviously is to bring that loan current again. And there are several ways that they can do that. And those are kind of lumped into what in the industry is known as loss mitigation. So I'm going to touch on the 6 main categories for loss mitigation. So you've got a repayment plan, a forbearance plan, a payment deferral, which is slightly different than a modification, a short sale, and a deed in lieu. So we'll start with a repayment plan. So both the repayment plan is really just a plan to bring the loan current. So that allows the borrower an opportunity to make payments without having to make all the payments at the same time. So they could take a payment and reduce it to 2 payments, 4 payments, 6 payments. Sometimes they even go up to 12 payments. So that is to help the borrower bring that loan current. And then the next option would be a forbearance plan. So the forbearance allows the borrower to reduce the amount of payment that they're making or to not make payments for a certain period of time. And this is used a lot of times when borrowers are dealing with short-term financial situations or temporary type situations. For instance, maybe one of the borrowers were ill or hospitalized and they were out of work for a month or so. And during that time, the lender can decide to forego the payments for that period of time. At the end of the forbearance, though, the borrower is required to bring the loan current. So that can happen through a lump sum, which does happen sometimes, but I say probably more frequently they go into a repayment plan. And that's where they'll, again, go back to making payments, reduce payments, or spread out the payments that they're making.
And so
it also could lead to a modification. Go ahead, Justin.
Oh, no, I was going to jump in. So when we went through what we experienced, through 2020, 2021, 2022 with COVID, that's exactly what many of the homeowners that elected to have some kind of consideration during the pandemic went through, right? It was a forbearance plan. And then many of them actually exited that plan utilizing the repayment option or one of the others available.
Yeah, and too, some of these people that did forbearances actually ended up tacking that amount onto the end of their loan, which I think at some point is going to lead to some opportunities for real estate agents, because, and I've already seen in our market a couple of these personally where I had spoken with people about listing their home for sale, but when they go to get a payoff, it's different than what they thought it was because they forgot. I don't know how they forget, but it happens. They forgot that this forbearance was actually tacked on to the end. And so in addition to that missed payment, they're also tacking on late payments. Sometimes there's additional fees that are tacked on. And then keep in mind too, when you're on a forbearance, you're not making payments. And so when your property taxes or your homeowner's insurance goes up, then you've got that amount that has to be added back in. So these forbearances can be very beneficial in helping people save homes. But it can also kind of backfire too if they're not mindful of really what's going on.
And I have a comment to that, Sharon. I
Sure.
mean, I know you're in the Texas market as well. Here in Austin, if you've been following the national news, our price points have been dipping rapidly. We're, I think, 15% down. So I would imagine that anybody that entered into forbearance in the last 2 years is now looking at a house that is not as valued as highly as it was prior. And I'm just curious how that might be affecting, because if you did follow Rick's webinar one, he did mention that most homeowners, I think something like 90% of people that have a loan are in positive equity. But I wonder when this forbearance does get lifted, and I believe it's happening in the next couple of months, how that's going to play out.
Well, I think most of them have already been lifted. So I think we might see signs of that sooner versus later. But then you also have, situations where, you know, when the borrower entered into the forbearance, they thought their situation was going to be A, but it ended up being B, which was far worse. And so, when they agreed to enter into the forbearance, they thought things on the backside were going to work out for them, but that is not happening in every instance, unfortunately.
And I think that, to Miguel's point, that's something that's been consistent throughout the country, right? Many of the markets have been impacted, anywhere like in California, I can speak to 10 to 15%. And what's going to happen in the next 12 months is really, I think, going to be the deciding factor, not just here, but across the country. Will we see a correction of another 10%? Will it be 15%? And to your point, Sharon, I really think that the consumer who's dealing with the brunt of inflation and then balancing that with their situation is going to need to look to someone for solid advice. And thank goodness we're doing this webinar today, and thank goodness for AREAA that can provide that this education so it can be passed along to the consumer.
No, Justin, that's a great point. And we're going to touch on this a little bit further into the presentation too. But, once you become aware of a situation where a borrower's in default, there are a lot of opportunities for real estate agents to help them. You don't have to wait till a property gets to REO to be of assistance. And in fact, I think it's much more rewarding if you can help people actually keep their home. And there are ways that I've seen agents do that across the country. So, but I think understanding, the entire process and how things get from, someone making their payments to now it's going to foreclosure on the the steps of the courthouse is important, because I think knowledge is power, and knowing these different steps and knowing, hey, just because you are in a forbearance doesn't mean that you have to necessarily lose your home, and I can help you in this way. So anyway, all right, so we'll move on to the next two. So I kind of touched on payment deferral a little bit. So basically that's taking the delinquent payments and it moves it to the back of the loan as non-interest bearing. So that amount's not gaining, not being assessed additional interest, but there are often other fees and penalties that are involved with that. But this option allows the borrowers to keep their payments the same, so they're not having to incorporate the amounts that they weren't paying. And then modifications have been around for years. So a modification is basically used when a borrower becomes 90 or more days delinquent. Now, I have seen instances where it hasn't been that far delinquent and a modification was performed, but this is basically used to recast the loan, if you will. So it can make a change to the interest rate. And I don't know if today, if necessarily a modification would be helpful to some people, because their rates were probably lower before they are now. So that, that's going to be interesting little change for us, but it definitely changes the maturity date. So it will extend the amount of time that the borrower has in order to pay off that loan, and allows for, the payments that were capitalized to be incorporated. Justin, you got an add on this?
No, I mean, I think, well, you brought up the points about the rates fluctuating and, dealing with today's interest rate environment versus 2 or 3 years ago. Question is, with the modifications, are borrowers potentially looking at a mod where they've got a 40-year loan, 37-year loan? I don't know.
Yeah, that could be. That definitely could be. Whoops, moved too fast. Last two loss mitigation types. One would be a short sale. And a short sale is simply a situation where a borrower is selling their home and they owe more than their home is worth. And so in that instance, the unpaid amount can be forgiven, and but I say that, and then in some instances, the borrower is looked to, in a lot of instances, especially if they have mortgage insurance coverage. A lot of instances, the borrowers are encouraged or asked or even forced in some situations into a plan to repay either all of the shortage amount or a portion of the shortage amount. So it's not like, you owe A on your home, you sell it for B, and you just get to walk away and the difference goes away. It doesn't always happen that way. It does sometimes, but there are instances where the borrower is still on the hook for that difference. And then the last would be a deed in lieu. So a deed in lieu is when a borrower voluntarily transfers title or the ownership of the property to the lender or the servicer. So they still lose the home. They're not going to retain the home in either of these two situations. But it does not look as bad on their credit when they're offering a deed in lieu. I'll say deed in lieus are used a lot in situations for probate cases where the borrower has passed away. There's really no need to necessarily foreclose on an estate. So a lot of times the lender, in order to speed things up, will accept a deed in lieu and allow the family to go on down the road. And those work a lot when there's not equity in the property.
Sharon, going back to the short sale, in what instance is it I guess a monetary instance, or is it when you say that maybe some of the overages might be forgiven, like can you kind of pull that apart a little bit and kind of explain when that would come into play?
Yeah, so that really depends on the circumstance and who the servicer or the lender is. From looking back at my days at Freddie Mac, there were situations, depending on the circumstances. So like if it was a medical situation and this was the best way for the borrower to move on in their lives was to sell their home at a loss, but they had tons of medical debt. In those situations, a lot of times they didn't pursue any type of a deficiency or look for a repayback of that. But there were a lot of circumstances, and I think I saw more of that in the MI space. If there was mortgage insurance on the loan, it was more them pushing to get repaid on their contribution, because like they still have to pay their claim. And so they want to mitigate their loss on that claim. So they'll ask for a portion or all of it to be repaid. And as far as specific circumstances, I can't really think of one off the bat that led to one way or the other. But I can say, when you look at it as a whole in general, it was more around things that were within a borrower's control and things that were outside of their control that kind of led to those decisions.
Right, case by case, probably, if somebody wasn't just completely irresponsible, for instance. Right on.
And the scary thing with short sales is really, let's say that you are forgiven, right? And let's say, for numbers' sake, $100,000. The borrower's released, they approve the short sale. Many borrowers forget or don't realize that there's tax implications to that forgiveness. and all of a sudden they've got a tax bill for $30,000 or $40,000, not understanding why. So really getting familiar with that process will be key when you're dealing with short sales.
No, definitely. That's a good point, Justin. Yeah, and the same happens with foreclosure too, though. So, and we're gonna move on to foreclosure. That's a good segue. So, foreclosure is a legal process in which the servicer or bank or lender attempt to recover the amount owed on the defaulted loan by taking the ownership back to the property and selling it. So it's not, there's a lot of misconceptions out there from some that servicers and banks just want to foreclose to take a property back. It's an expensive process for them. It brings with it a lot of risk. It brings financial risk, it brings reputational risk. And so they don't want to foreclose if at all possible. But if you walk through all of the loss mitigation functions, you've worked with this borrower and tried to bring the loan current, and that's just not happening, at that point, there really is no other choice but to foreclose on the property. So typically this doesn't happen until a borrower reaches 120 days of delinquency. So there are, we're going to talk in this section about two different types of foreclosures. We're going to talk about deficiency judgments, and then we'll also talk about redemptions. Excuse me. So first off are two foreclosure types. So there is a judicial foreclosure process, which goes basically through the courts, and those are typically in states that use a mortgage to secure the note. And then there's a non-judicial foreclosure, which happens in deed of trust states. So these are states that the deed of trust is used to secure the note. A lot of times you'll hear people refer to it as the tortoise and the hare. So the judicial side would be the tortoise. It takes much longer to acquire title. And the deed of trust, like Texas, is really a quick state. It's the hare. And so it gets to the finish line much faster. So the amount of time for foreclosure in each state varies, and we're not going to get into the specifics of each state, but it can vary as little as 30 days to 10 months. So I would say if you're not familiar with your state's process, that would be probably one of the first things that you would want to do. And there's some good websites out there with information. I want to share two of them with you that I use for information and on and off. One is realtytrack.com. And then the second one is foreclosure.com. And I like foreclosure.com because it includes a really easy to follow chart that kind of outlines for each state, whether it's judicial or non-judicial. And then just to mix things up, some states you could have either, like, and I can't think off the top of my head which ones they are, but there are several states that it can either go judicial or non-judicial. So, and then keep in mind for the foreclosure process that there are delays around every corner in foreclosure. So just because a lender has started foreclosure doesn't mean that it will ever even end up becoming an REO property. So there are instances where the servicer one is required to continue their loss mitigation efforts. And so during the process, they're still trying to work things out with the borrower until it gets to the foreclosure sale. But you've got probates, bankruptcies, litigation, military indulgence. Excuse me. Justin, you want to talk for a minute?
Well, and that's, I mean, for California, for example, they have both options available, both judicial and non-judicial. The majority of them, to Sharon's point, actually utilize the non-judicial process. It's a much quicker, much more efficient, but they have both options available. In the state of California, for deficiency judgments, we typically will see the that will be underneath a judicial foreclosure, whereas the non-judicial process is the receipt of the property. I did want to remind everyone, AREAA has amazing benefits to its members. So part of that consists of a discount. You guys have available to you a discount for 25% on foreclosure.com. And so feel free to check that out. If you want to learn more about what's available on the site, some of the data that's driven behind it and whatnot.
Yeah, and the chat has the link there. It's part of your AREAA member benefit. So make sure to click on that link in the profile and enjoy that 25% discount. So it's perfect.
All right, I'm back. Sorry.
Welcome back.
All right, so here's a breakdown of the judicial and non-judicial states.
I'm seeing a correlation between some of the states that have higher REO volumes typically being more red versus the blue.
Interesting. And why do you think that is? Is it, I mean, judicial versus non-judicial, is that going to be a factor in how these things get accelerated? Is that what you're saying?
Well, for New York, for example, it could take them 5 years or 10 years. They're still working through properties from 2008. Whereas in California, we don't see that backlog of inventory. It's just a much lengthier and costlier process. And that's a question I'm curious.
Back to the tortoise and the hare analogy, it makes sense.
Well, and I'm curious, Sharon, on the, we don't see a lot of judicial foreclosures in California, but in states that are non-judicial, are they more apt to seek a deficiency judgment because of the elongated process and cost associated with that?
You know, that's a good question, Justin. I'm really not sure. I've never really looked at that to see. Some states don't allow for a deficiency, though. You know, there are a lot that do. Excuse me. All right. Hopefully I'll stop choking to death here. All right, so we are going to talk about deficiencies for just a second here. So, and it does depend on the state, but there are several states and that allow for a deficiency judgment, and that doesn't take place until after the loan is sold as an REO property. So once the lender sells the home and they've paid all their expenses, all their real estate expenses, any expenses for maintaining the property during the REO process, then they determine what the loss actually is. And they can actually go back and file a deficiency against the borrower for the difference in what the foreclosure sale price was and the amount of their loss. So again, another tax implication for them if they go to foreclosure. All right, so redemption periods. We haven't really talked about redemption yet. So a redemption is a period of time that occurs typically after the foreclosure sale, when the borrower could come in and reclaim the property by paying everything that's owed on it. So even if it's been referred to the attorney and it's the day before it's going to foreclosure sale, if they have the funds, they can come in and stop foreclosure. So, and that's like a pre-foreclosure redemption. There are some states that have that, but redemption periods vary. Most of them, I would say, are not terribly long, but there is a state or two where the redemption period is like a year or longer. Most of them are, I would say, between 30 and 90 days. And so this is a list of states that do have the period after the foreclosure. And so this kind of becomes a gray area for lenders and servicers when they're trying to dispose of the property as an REO. So if it's in a redemption state, that can cause issues because, again, the borrower can come in and pay to keep their property. And so there are instances where lenders and servicers will ask a borrower to waive their redemption right so that they can go ahead and market and sell the property without waiting that entire time. So sometimes that comes with a monetary incentive. There are times that I know that both GSEs have offered to purchase redemption rights from a borrower just to move on and dispose of the property. All right, so next, we wanted to share some statistics on the default and foreclosure process. So I was recently in Vegas or in Henderson with Justin, and Miguel was there as well. And I think some of you on the call were there too, at the NADP summit. And this particular slide was shared at the summit in a presentation that was done by who did Justin? Do you remember who it was?
Yeah, that was the vice president of the Mortgage Bankers Association.
I couldn't think of their name though.
Was it Marlene?
Anyway, she was super good. Like sometimes they talk way over your
Marina
head.
Walsh.
Marina.
There you go.
I knew it was
There
a
you
name.
go. Yeah. Sometimes they talk way over your head and you're trying to follow, to absorb information and learn from what they're telling you. She was super easy to understand. She made it very relatable. And this slide is taken from her presentation. So it shows on the left-hand side, you can see mortgage delinquency rate by type. I think of note here, if you'll look, the blue line at the very top. So the highest numbers are FHA loans, which I think are interesting. And then on the right-hand side, these are loans in foreclosure and new foreclosure starts. And so you can kind of see here too, if you look by year, things are starting to tick up. So I have, Justin, you want to talk about this one? You have anything you want to add?
Yeah, on the ones on the right, so you can see start rates is red, blue is the foreclosure process. So these have been trending down ever since the downturn back in 08. You do see a little pickup there on the start side as they had the COVID moratoriums, and it pops up in 2022 when those were lifted. But you can still see that the current rates of starts are still at historic lows. But what we haven't seen the impact of yet, which they are very good about sharing with us, is the impact of the increase of household debt that they're seeing throughout the country.
Yeah, so actually several of the speakers talked about that. And I think that is going to definitely have an impact on what happens, in the REO and foreclosure space going forward, because credit card debt is up all across the country. And when that happens, people are paying more for more, or more for the same, basically. And so it is going to have an impact at some point. And I don't think we know quite what that looks like yet. And then,
and it was just interesting that she did point out about the spending is we did not see a decrease in spending. We just saw the spending transfer into debt spending, which is also kind of a red flag going forward.
Yeah, because again, it gets back to that point. It's at some point you have to make a decision about what you pay. And unfortunately, a lot of consumers don't understand, the difference between you paying a mortgage payment and paying a credit card, the impact on your credit score. It's significantly different. I mean, you don't want to be late on either or miss either, but you definitely want to take care of your mortgage payment. And then Rick shared a couple of slides with us that we included too. This one is the foreclosure start. So I think of note here is that that the numbers are showing that we're running roughly what is it, like 75 to 80% of levels from 2019. So 2019 is over in here, and so we are seeing an uptick, but really it's an uptick to numbers that were relatively level at any rate.
Eh,
Did you want to add something, Justin?
Well, I was thinking about what you had shared about the consumer debt, and we saw the Fed funds rate creep up, what, 1/4 point yesterday? But that lends to what Jerome Powell had said 2 weeks prior, right? It was, hey, American consumers are going out, they're spending money like there's no tomorrow. We're not seeing a tapering of that activity. And so I think yesterday's rate increase is a commitment to the resolve of getting this under control.
Mhm. All right, so these are foreclosures completed. So this is after it's been through the foreclosure sale and now it's become an REO. And it looks like, compared to before, pre-crisis type situation, it looks like we're in the 30% range or so from 2019. So, before everything was locked down. So not quite there, but things are ticking up, but there was nowhere for it to go but up, so, people have been talking for the past couple of years about a tsunami of foreclosures. And I think, the majority of us that have been at this for a long time aren't expecting a tsunami. You know, obviously it has to go up because there were loans that nothing happened on for years. And I think we're seeing that a lot with FHA loans. I'm seeing more properties. If you look out on the HUD Home Store, you'll see more properties listed there than there had been in the past. And so, that's an indication that they're starting to clear out some of this that's just kind of been sitting there and nothing happened to. And keep in mind too that some states, probably most states, have a requirement. Once you start the foreclosure process, it has to be finished within a certain amount of time. And for a lot of these loans, when everything was locked down and there were no court proceedings happening, these loans should have been going through the process and they didn't. So for some of these, the lenders have had to start over. And so, they are going to make it through the process. It's not going to be all at one time. It's not going to be 2008 numbers or probably even 2012 numbers, but the number of REOs we see each month has come up slightly, and I expect for the rest of this year for that to continue.
Hey guys, I have a question from one of our viewers. It's kind of backtracking a little bit to the deficiency waivers. Can you request a deficiency waiver? This is from Cecilia. Can you request a deficiency waiver from the bank on a foreclosure? I know with short sales you can, just curious, especially if you're able to negotiate a redemption, shorter redemption for deficiency waiver. Thoughts?
Well, I know in the state of California, if it's purchase money, the law does not allow for a deficiency judgment. The property is taken back in lieu of that. So I can't speak outside of California, but that's kind of my 2 cents on that subject.
Okay, well, I hope that answers Cecilia's question. If not, I'm sure we'll get a follow-up.
All right, and then really just the last part to touch on is, so this is in a situation where none of the loss mitigation activities were successful in helping the borrower retain their home. And, the loan is still delinquent. So at that point, the lender or servicer is going to take it through the foreclosure process, and the property will be sold at the foreclosure sale either to a third party or they will take it back themselves. So if it goes to a third party, it basically doesn't become an REA. In that situation, that property is purchased typically by an investor who's going to take the property and do something with it, probably rehab it and either resell it or put it out there as a rental property and increase their rental portfolio. But for those that the bank acquires title to, those are the ones that they have to turn around and sell to recoup all of the foreclosure expenses that they outlined. Foreclosure expenses, they also have to advance property taxes on these homes. And so, if you've got years of foreclosure and years of property taxes, they've got to recoup that. So That's the whole end game after it goes to foreclosure sale, is for them to mitigate their loss as much as possible. What you
Now,
got?
are the banks held to a different standard than, you know, the private investors? Is that what it is? Is the regulation that causes them to have, or is it just also just financial on their end?
Well, there's reserve requirements, right? On the servicing side, where if they foreclose, there's some additional financial restrictions tied to that compared to, you know, that's why there's so many efforts to try to keep the borrower inside the home. It's the best situation for everyone if they can procure that solution. The least optimum solution is foreclosure. It's the most costly, it takes the most amount of time. And
Yep.
so really lenders and services, and I think Sharon actually opened the session with this. They don't want foreclosures. They don't want REO properties. It's not a win-win for anybody.
No,
Yep.
it's not, definitely not.
Yeah.
No, and a lot of times, you know, on properties that the lender doesn't want back. So there are those properties that they've looked at the numbers and they've determined that it's best for them not to acquire title to this property for whatever reason. Could be condition, it could be, you know, a specific stigma or situation about that home, and they don't want the reputational risk, they don't want the financial risk, so they're gonna go to foreclosure sale with a lower amount to encourage a third party to come in and take it off their hands, because third party's not going to know everything that the bank knows about this property. So those that are purchased by third parties often are properties that the lender, they don't want back. Yeah. So that's pretty much it. So, I mean, I walked us through with the help of Justin and Miguel, getting us through to the REO piece. And I understand that you've got some future sessions coming up that will dive in deeper into this space. But I guess we have time for questions, Miguel.
Yeah,
Well,
absolutely. Yeah. And, you know, we got about 10 minutes left. This is a good opportunity for you guys to kind of pepper us with any questions you may have. In the meantime, I do want to just kind of remind all our AREAA members, we do have the Diversity Fair Housing Summit coming up. That's going to be May 17th through the 19th. There will be some representatives of the various committees there. So hope to see you guys out there. Definitely make sure to be checking your emails for those invites, and also for some of the discounts. So, oh, there it is. AREAA National. It's like Jiminy Cricket on my shoulder with the links. This is beautiful.
Well,
We're all working together.
I was going to say, we were talking about this before we got started on the call, but Justin and I have both been to the session before. And if you haven't been before, I would highly encourage you to attend. You will learn so much. You'll develop relationships with some really great people. And I think it's a great opportunity. Unfortunately, I can't attend this year, but I'm very disappointed in that. But yeah, if you're on the fence about going, get off the fence and just get out there and make get your reservations made.
Absolutely. Okay, we got a question here. Could you explain how a bankruptcy or a tax lien sale may change the process?
You want to take that, Justin, or you want me to?
So, I mean, in regards to a bankruptcy proceeding, typically that will elongate the process, right? It doesn't alleviate the foreclosure. It just slows that process down. Tax lien, well, taxes have to be paid. I don't know if you want to cover the tax lien item, Sharon, but
yeah. So yeah, with a tax lien, I mean, their taxes are going to be paid. So a lien isn't going to slow things down. Now, if it were to go to tax sale, you know, if it actually got that far down the process, then it does change. It's a big game changer for everyone. And if a GSE is involved and that servicer just bought a new loan back into their portfolio, because, you know, they're responsible for making sure that taxes are paid on their properties. Although, there have been instances where things have fallen through the cracks. But
Yeah, yeah. I mean, one thing I want to make sure that everyone on today's call realizes, if you are a realtor and that's your specialty, right? It is the Asian Real Estate Association of America. There are opportunities all along this process. Getting educated is going to be paramount because this complex is not a simple one. It is very complex. There's a lot of nuances to it. It's very local. And, from helping a homeowner move through navigating the loss mitigation options is paramount. We kind of went through some of those high level. In the short sale process, you could represent the borrower in the sale and listing of their property. Even at the courtyard steps. I mean, I've heard stories where agents have made 30 or I was talking to Rick yesterday or the other day, and he mentioned he was talking to an agent who did 80 closings at the auction, where he's got investors that he works with. He provides value. They not only allow him to list the properties that he gets at auction, but also give him additional opportunities. So this is paramount. There is additional training because you're an AREAA member. The National Association of Default Professionals, NADP, they actually pass along on our certification courses or any of our events. You guys can participate at the member pricing. So if you're looking to get further education in this area, and this is something that you want to focus on, I encourage you to check out defaultpro.com. Or reach out to AREAA. They'll give you the discount codes and how to sign up and take advantage of those savings.
What another great benefit that AREAA provides. And I just, as a first-time attendee of the NADP conference, it was very awesome to see AREAA represented, and just kind of like the cross-pollination of professionals that I deal with just here locally, also with AREAA, but now new friends that I make in the default space. So I just urge all you members out there to really dig into your membership benefits, because you should definitely leverage that, especially for the small fee we pay. There's a lot of discounts that pay way more than what you paid for your membership. So take full advantage and definitely get with your local chapter if you have questions about all the benefits that are available to you, for sure. Let's see, I had one more, hold on. There was one more question. It's kind of a comment / question. To my understanding, loan servicers are putting people on 40-year mods to get them into the 3-month trial, which gets them off foreclosure status. This also helps them apply to the state, I guess that's California housing funds if they qualify. Have you heard of this on your end? I guess, Justin, can you speak to that?
Yeah, I mean, that's something new that I've heard about, the elongated term, right? 40 years, that's something that's new, that's in the mix. I don't know if it was based on the 3-month trial mods. That's more on the servicing side. I'm more on the real estate side. But I think it all goes back to the initial premise of what lender's intention is. If we can keep the borrower in the home, we want to. Right?
Absolutely. Absolutely. Like you said, it's not in anyone's best interest to foreclose. Which, obviously someone called this industry the dark side on LinkedIn.
Oh,
But
Rick had shared it's only available on FHA loans.
Okay.
And it's part of their loss mit program.
Well, awesome. Well, once again, everyone that joined us, thank you so much. Thank you so much to our presenters, Sharon and Justin. You guys, I think you provided a lot of great information. Those of you guys that are following the default committee, stay tuned. April 19th, we're going to be digging into pre-foreclosures. I'm excited for that. So make sure you check your emails, join that webinar, and we're going to keep you guys in the know as far as the default space is concerned. So I'm Miguel Benavides. Thank you so much for joining. You guys have a wonderful day wherever you are. And yeah, love you guys.